So, hello everyone, welcome to Min's Unlocking Global Markets powered by Appreciate. Today, we are exploring a truly game changing idea for Indian investors as to why index funds and ETFs are a very smart way to go about your global investing journey. For many, I think the US market seems very complex and distant because we don't hear about it often in our surroundings. But um, we all know that with the new industries that are coming up and the new ideas that are coming up, US is usually the global powerhouse of such industries, such as, say, for example, semiconductors or all the things that we hear about around artificial intelligence, so on and so forth. So I think it's always a good idea to consider what's happening in other geographies and consider investing in them too. Okay, so now that we've covered why US investing sounds like a good idea, let's deep dive into that a little bit, right? So first and foremost, why should we invest beyond the Indian borders? Of course, the obvious answer is that you would want to diversify, right? When we look at our portfolio, not only do we invest in equity, but we also consider debt instruments, we also consider gold and real estate, so on and so forth. So when it comes to your equity portfolio, it always is a smart idea to also include other geographies as a part of the whole portfolio. And US obviously is a standout because it has probably 60% of the global largest companies, right? So that obviously becomes a standout for us as Indian investors. Um, Also, diversification helps sort of tap out the risk. For example, if for a particular year or particular season, the Indian geography or the Indian markets aren't doing as well, if you also invest in the US markets, then a geography gets spread out because every country also inherently holds a risk, whether that's the US or whether that's India or China, right? So if you diversify your portfolio and you invest in more than one geographies and locations, that risk sort of gets spread out. Another major reason why you should probably consider investing in the US market is the growth potential there. We've kind of lightly touched upon that in the brief introduction that we talked about. But um, there is so much growth potential that lies with the US markets because it has a lot of sectors that are currently underrepresented or not represented at all in the Indian market, right? So, for example, cloud computing or advanced semiconductors, artificial intelligence, so on and so forth. And also, another bigger potential that we kind of ignore is the rupee depreciation that's happening year on year. So last year, the rupee depreciated around 5 to 6% against the US dollar. So even if you say that, okay, I made about 8 to 10% in the US stock market, but when you add to that the depreciation that happened of the rupee, you're suddenly looking at double-digit growth, right? So that is another bigger growth potential that shouldn't be ignored by the Indian investors. Now, once we've talked about why investing in the US market seems like a good idea as Indian investors, the obvious potential question is how do we go about doing that, right? So there are two major ways you can invest in the US market sitting from India. So the first one is obviously the direct route. Again, very similar to India. You open a brokerage account, but rather than investing in Indian stocks, you invest in US stocks. Right. So again, this is the more direct route because there is no professional help and there's no one professionally managing your portfolio. It's pretty much you taking the call that, okay, do I like the fan companies all of a sudden? And I feel like there is a potential there. So I would want to invest there. So that is just your direct route, which is why the expense ratio here is obviously lower because there is no professional, sort of managing your portfolio for you. But if you feel like I could use additional help, I could, because I'm fairly newer to the US markets, I could use like directional help as to what to invest in, so on and so forth. Then there is obviously a managed route available for you too, which means that you invest through Indian overseas mutual funds that provide US equity exposure, are more managed, which is why the expense ratio is slightly higher, but you get a more managed fund and it's slightly more professional rather than you taking individual bets. Okay, now that we've talked about the two paths that you can use to access the US market, let's also talk about what are the different instruments you can use to invest in the US market, right? The first one is the very obvious one, which is US stocks, which means that you buy a part of a US based company. Say, for example, you feel like with the new iPhone launch, you feel like, okay, Apple is the company that I would potentially want to invest in. So you just buy a share of Apple, right? But from what we understand is that for an Indian investor, buying individual shares of US markets can be extremely expensive, which is why platforms like Appreciate kind of help you buy fractional shares as well. So you can start with as little as 1 rupee also. And say, for example, you feel like, okay, I just want to invest probably 1,000 rupees in Apple as a company, then that's the amount that you invest in. You don't have to potentially buy one whole share. You can also buy fractional shares using platforms like Appreciate, right? Um, yeah. Now, what are the benefits that one can see when you buy stocks or US stocks in general? Is that when you put all your money in one company and that performs really well, the probability of it obviously is debatable. But if that company performs really well, you get extremely high capital appreciation. Say, for example, you put all your money in Apple as an example, not a recommendation, and Apple as a company comes out really strong, has really strong quarterly reviews and really strong financial statements, then that particular part or that particular share that you bought for the company can quadruple also within 1 year, right? Giving you infinite results. So, yeah, when you kind of put all your money in one basket, you obviously run the risk of high reward, but obviously the risk is also extremely high, which is why when you're a beginner investor or you're not someone who's very seasoned when it comes to the stock market, a lot of a lot of people recommend starting out with either ETFs or index funds. I hope what we mean by US stocks is clear. So we'll now move on to the next slide, which is about US ETFs. Now, before we deep dive into US ETFs, let's try and understand what is an ETF, right? So an ETF basically means an exchange traded fund. Now, what does that mean? This means that basically, rather than buying one individual stock, you buy a basket of stocks, right? So an ETF basically means that you kind of diversify your risk. Rather than investing in one company, you invest in a lot of companies. If I have to give an Indian market example, an example of an ETF would be Nifty 50, right? Which means that you invest in the top 50 companies of the country. But a US counterpart of that will be S&P 500, which means that rather than investing in just one company, say for example, Meta or Apple or Amazon, you invest in the top 500 companies of the US. Obviously, what that results in is that you get instant diversification because you're not just investing in one company, you're investing in 500 if you're investing in S&P 500, and that kind of dilutes your risk. What that means is, say for example, a company, chances of that happening is very low, but for example, Apple doesn't have a good year, or like it goes under, right? Or probably files for bankruptcy. All of this is hypothetical. But what that means is that you have other 499 companies to rely on rather than just putting all your money in one basket. So, of course, a very major benefit of investing in an ETF or an exchange traded fund is that you get instant diversification without even thinking about it. And it also gives you a sense of professional management because some ETFs are not just kind of mirroring the index, but they're actually professionally managed. For example, QQQ is a very, very popular ETF of the US market, which invests in selected innovation companies, right? So companies that are doing really well in hardware, software, your AI, cloud computing, so on and so forth, are very, there is a lot of strategy that goes behind selecting those companies, and then the investment happens. So you also get a sense of professional management with certain ETFs. So yes, there are ETFs that invest only in indexes. For example, they try to benchmark the market, for example, the S&P 500. But then there are other ETFs that kind of give you a more professional sense of investment by selecting certain kind of themes or certain kind of sectors or certain kind of ideas. So ETFs can be based on a lot of different things. One of them is an index. One of them is, okay, we just want to benchmark the largest companies in the US. But another kind of ETF could be, okay, we want to make an ETF around innovation companies in the US, or we want to make an ETF around the companies that only give really good dividends, so on and so forth. So it could be theme based, it could be sector based, it could be trend based, it could be index based. So there are a lot of other options to choose from. But the important takeaway from this slide is that we understand what an ETF is, what are the benefits of an ETF over a stock, and yeah, why that's a good bet to take if you're a beginner level investor. Now, a lot of people get confused between what is an ETF and what is an index fund, which is why we've created a whole new slide explaining what is the nuance between the two, right? So, a lot of people sort of use these terms interchangeably, and very honestly, that's fine. But like for a beginner level investor, you could say that an ETF is also an index fund. But if you have to go into more nuanced detail, if I have to explain it very simply, an ETF behaves more like a stock. What that means is that you can buy or sell it anytime in the stock market, right? But an index fund is more similar to a mutual fund. What that means is that you can only buy or sell it at the end of the day, right? So there is an NAV that's decided for an index fund at the end of the day, and that's the price that you buy or sell it at. Whereas an ETF has its price decided all throughout the day, much like a stock, because it's traded throughout the day. So the key nuance difference between an ETF or an index fund is that an ETF behaves more like a share, whereas an index fund behaves more like a mutual fund. But at the end of the day, they do serve very similar purposes, which is that both of them are at the end of the day basket of stocks. So if you want to instantly diversify, you could choose either index fund or ETFs, because at the end of the day, that's their key purpose. They help you diversify instantly. So again, let's understand this with an Indian counterpart, and then we'll draw a US counterpart to it, because I think that's just easier to understand considering we're all in India. Right. So, for example, there is a Nifty 50 index fund and then there's a Nifty 50 ETF. So, at the end of the day, they're both Nifty 50. They're both kind of benchmarking the index. They are both telling you about the top 50 companies in India. But the key difference between the two is that an index fund is something you can only buy and sell at the end of the day, whereas an ETF you can trade throughout the day at market prices with real time fluctuations. So, I hope this nuance is clear. If we have to talk about index funds that kind of deal with the US markets, we have mentioned quite a few examples. If you want to invest in mutual funds through Indian funds, right? So, for example, there are Indian funds that allow you access to US funds, US stocks, or US markets. Now that we've talked about what are the different ways that you can invest in the US market, there are basically two investment strategies that you can take use of, right? And again, very, very similar to how you would do it in India, but we'll explain it more in the US context. The first strategy is obviously the lump sum approach. What that means is that, say, for example, you have 1 lakh rupees that you want to invest, and you're like, okay, I would want to diversify now in the US markets, and you take all that money and invest in one go. That's your lump sum approach, right? So, what are the benefits of it? Say, for example, if the market is in an upward trend and you invest right here and the market is bound to go up, you make use of your entire capital for that appreciation. So, not only is your base value higher, what the result is also extremely high, right? So I hope that makes sense. So the lump sum approach is great if the market is already in an upward trend and you feel like, oh, I can sort of ride the wave. But the negative around lump sum approach is there is no way we can tell if the market is in an upward trend or a downward trend, or how short-lived or long-lived that trend is, right? So if I have to draw an example, if you remember what happened in March or April of 2020 in India, is that everything was going well and all of a sudden everything stopped and the market kind of crashed almost by 50%. What that tells us is that there is no way to tell that, okay, is this like a market upward trend? Is this a downward trend? Even the biggest investors in the world cannot tell or cannot time the market. So lump sum approach, while can prove to be really beneficial if you have a large base capital amount and you're like, okay, I can see like an upward trend going around and I want to kind of ride the wave, it can be really beneficial for that. But if you're a beginner investor or just investing alongside your 9 to 5 and you don't really have the time to kind of also keep in touch with what's happening in the market every day, and that to different geographies, right? So something that is recommended for individual or small level or beginner investors is SIP, which is systematic investment plan. Now, what this means, which is very different to a lump sum approach, is that again, you have the same corpus of 1 lakh, but rather than investing the whole amount in one go, you break it down to 10,000 rupees and you invest 10,000 rupees every single month. Now, what that helps you out with is the fact that, say, for example, you invested in the month of October. Right now, we're in October, right? So you invest 10,000 rupees and the market kind of down performs. But then you invest again in November and the market performs slightly better. In December, also, it performs better. In January, it drops. But what that means is that you kind of get the average of the next 10 to 12 months, right? Depending on your corpus. So that gives you a better probability chance or better leverage in the sense that the market could go up or could go down, but because you've divided your corpus across the months, you have better probability that you'll get a good average. So there are a few months where the market might do good, there are a few months where the market might do bad, but on an average, you'll get a pretty decent result. And that's the idea behind a systematic investment approach, that no matter how the market performs, you just keep investing. And like within a time horizon, say for example, whatever your time horizon is, it could be a year, it could be 5 years, it could be 10 years, you see that your results kind of average out. So in India, we call that rupee cost averaging, but when you're investing in the US, you can call it dollar cost averaging, and the result almost remains the same. The idea is the same, the concept is the same. It's just that obviously the currency differs. So I hope the idea of lump sum and SIP is clear, and why SIP is something that is recommended by experts, especially if you're a newbie investor. But if you feel like you have a sense of a particular sector or a particular theme, and you know that, okay, this is bound to go up, there is no way that it would go down, and if you feel like you have those sort of insights, then by all means you can go for lump sum approach. But something that we recommend that beginner level investors do is definitely SIP or systematic investment approach. Okay, now as promised, we told you that we'll tell you how to read an ETF, right? So now that we've discussed the different ways that you can invest in the US market, and we've also concluded the fact that if you are a beginner investor, then probably an ETF or an exchange traded fund is the way to go about, because it gives you instant diversification. So through this example, we'll try and help you understand how to read an ETF, so that it doesn't sound that alien anymore, right? Again, what I would do first is give you an example of Indian ETF and then draw parallels with US ETFs, right? So let's say, for example, let's take a popular one in India. Let's say, for example, it's SBI Nifty 50 ETF. Now let's break that down. What is SBI? SBI is nothing but your fund provider or the AMC, right? That kind of helps you buy or take use of the fund. The next word, which is Nifty 50, again, is not very alien to us. Basically means that it's the top 50 companies of India in terms of market cap, right? And ETF is an ETF. So once we understand this, it's very easy to draw the parallel with a US based ETF, right? So let's, for example, take the example of a very popular US ETF, which is Vanguard S&P 500 ETF. Now, what is Vanguard? Vanguard is nothing but the fund provider, much like SBI, right? So Vanguard helps you build this, helps you buy this fund that we're talking about next, which is S&P 500. S&P 500 is nothing but the top 500 companies of the US. Much like Nifty 50 is to India, S&P 500 is to the US. So automatically you're investing in the top 500 companies of US, and ETF is an exchange traded fund. So it's very easy once you kind of break down word by word what that ETF stands for, right? And you can do that exercise with Indian ETFs or US ETFs. So if you come across something that sounds very alien to you, I think a very good exercise is to just break it down by, okay, what's the fund provider? Okay, what's the index that they're talking about here? Or what's the benchmark that's being talked about here? Or what's the theme that's being talked about here? And okay, and that's the ETF, right? So just by doing this simple exercise, you'll be able to sort of break down what an ETF is. Here in the slide, we've also mentioned, say, for example, an ETF, which is again very popular, is QQQ, which we've touched upon previously, which kind of helps you invest in innovative companies in the US. There's a breakdown of what the top holdings of that ETF are, right? So that has NVIDIA. Obviously, I think NVIDIA has been in the news for a while now. Microsoft, Apple, Amazon, Broadcom, Meta, Netflix, Tesla, Alphabet, and Alphabet Class C. So all of these companies we all know, right? So these are very popular innovation based companies, and these are part of the QQQ index fund, right? Sorry, yes, index ETF. So basically, that's how you read an ETF. Just break down every single word in terms of the fund provider, in terms of the index that's being discussed, and what that ETF is about. And I think you'll be able to very easily read the ETF. I think something that I also struggled with once I started investing in the US market is that we're just not aware of the fund providers there, right? Like those names seem very alien to us. For example, if you're in India, you know the names Motilal Oswal, and we've heard the names ICICI Prudential. So these names are very familiar to us because we've grown up with it. But there's nothing to be scared of. There's nothing very alien about it. It's just that these are, when you look at the US counterparts, you just see the fund providers there, and that's pretty much it. So there is no reason to kind of disregard them. Very easy to understand them once you kind of break down the names. Okay, now let's talk about certain advantages you can have as an Indian investor when you invest in the US market. There are obviously a few that we've already discussed in terms of diversification, but let's deep dive into a major reason why Indian investors should consider the US markets, which is kind of ignored by us as Indian investors. So yeah, let's take a look at it. Which is basically our currency depreciation. Whether we want to admit it or not, the rupee is depreciating against the US dollar every single year. In fact, last year the numbers were, on an average, it's 3 to 4%. But if reports are to be believed, it's actually closer to 5 to 6% last year, unfortunately, for us as Indians. But the silver lining in all of this is that we can take advantage of this rupee depreciation to kind of forward our returns. Let's understand this with an example, right? So say for example you invested in the S&P 500 and it only gave you 10% returns. You're like, okay, Nifty here is giving me 12% on an average, so why would I invest in the US? And that's a very valid question to ask yourselves. But what we miss and what we don't think about is the rupee depreciation that's also happening simultaneously. So while S&P 500 probably only gave you 10% returns in comparison to the Nifty 50, if you take into account the 4 to 5% rupee depreciation that's happening every single year, all of a sudden the results, or all of a sudden the profits that you make are a lot higher than what you would make in the Nifty 50, right? And this is just the index. Now we're talking about just S&P 500. If you look at ETFs which are more theme based, or they deep dive into industries which are currently booming, for example AI and cloud computing and semiconductors, so on and so forth, then the results can be a lot higher. So not only do you make a higher percentage from sectors that are present in the US and are currently underdeveloped in India, but you can also make the results almost double for yourself by also making use of the currency depreciation. And that's what this slide talks about, right? So you choose your ETF or stock in the US market, and then you see how the US dollar has performed against the Indian rupee, and then all of a sudden you see that your total results as are a component of these two things, and all of a sudden you see that you're making more returns in the US market in comparison to what you were making back home. Of our currency is more closer. That's what the last 10 years historical data tells us, which means that you can make up to 25% additional returns if you invest in the US market. Again, this is a component of not just investing in themes and industries that are currently not present in India, but also taking into account the depreciation of rupee that's happening every single year. Okay, now let's understand that with an example, right? This is very straightforward. Let's go through it one by one. So initial investment is 5 lakh. You invested in a US ETF when USD was 75 rupees INR. Currently, it's closer to 89 rupees, but yeah, we'll come to that. So the asset that you invested in grows 12% annually in USD terms over 3 years. So you get a CAGR of 12%, right? Every year you get that much growth. But if you also take into account the currency benefit that's happening, so the rupee weakens to 85 per USD over 3 years. So your return corpus comes out to be about 7.96 lakhs, which is a lot higher had you just taken into account the 12% growth of an index back home in India. So again, the idea of all these slides is that while yes, investing in the US market can help you out with diversification across geographies and you kind of streamline your risks better rather than investing in just the Indian market, you're also investing in a global market so that the risk of different geographies is kind of done and dusted. But another very, very important feature that I think we as Indians kind of tend to ignore is the depreciation of our currency that's happening every single year. Currently, the rupee is closer to 88, 89, yeah, against one USD, which, yeah, it's unfortunate. But if as investors we can make use of that by investing in the US markets, that's the idea that this example wants to drive home. Okay, now let's kind of try and summarize our strategic checklist and go step by step as to how you can go about investing in the US markets, just to simplify it for once and for all. Number one, you understand your options. As we've discussed, you can choose between direct US listed ETF or Indian mutual funds with US equity exposure. Each path offers distinct advantages and considerations that we've discussed previously in the slides. Once you've figured out whether I want to directly invest in the US mutual funds or I want to take the Indian route, then you figure out what your strategy is, right? You decide on lump sum investing for rising markets or SIP for volatility management. Again, we've discussed this in detail. If you feel like the market is rising or it has an upward trend, that lump sum might work out better for you. But if you're a beginner investor and you want to kind of, again, diversify your risk, SIP might be the better approach. Your choices impact both returns and your experience during market swings. What this means is that while you might make a lot more returns if you do lump sum investing and the market goes up, but the risk is also significantly higher, right? So say, for example, if the market goes down and you did lump sum investing, that means that you've kind of lost even your corpus to begin with. So if that's a risk that you're willing to take, then of course lump sum is the way to go. But if you want to do volatility management and kind of diversify your risk, SIP is probably a better way to go about things. And number three is always remember the currency impact. I think, again, we've discussed this in detail, but kind of to just summarize everything, never underestimate the INR USD exchange rate as a return multiplier. Long-term currency trends can significantly enhance your rupee dominated wealth. So what it's trying to say is basically, if you are currently making money in INR, and you know that it's depreciating against the US dollar, investing in the US market might be a very good way to kind of sideline that depreciation of Indian rupee that's happening, because not only are you getting returns of the US market, but you're also making use of that currency depreciation by investing in the US market. Right, now that we're done with the strategic checklist, let's quickly take a look at the US market performance, the long-term view, right? We obviously all do this exercise where we talk about, oh, Nifty 50 has given a 12% CAGR over the last 15 years. So now we're doing a similar exercise for the US markets to see how well have they performed, like are they even worth considering, right? Like how well they've performed over a 15-year period. So if you look at the S&P 500, which is the top 500 companies in the US, the returns in the USD terms is 704% total returns. And when we say total returns, this also takes into account your interest or dividends that might have gone out. So this is more comprehensive in comparison to just talking about S&P 500. A better way to talk about it is S&P 500 total returns. Similarly, when you talk about Nifty 50, in fact, a better indicator is Nifty 50 total return index, right? So again, the CAGR has been roughly 19.7%. So had you invested 1 lakh, you would now have 15.7 lakh in 15 years, which, to think of it, is an incredible growth. Because even in India, Nifty has only seen like 12 to 13% growth. Yeah, now let's talk about NASDAQ 100. So the returns in US terms has been 1,1203% total returns, whereas the CAGR has been 24.2%. So had you invested 1 lakh 15 years back in NASDAQ 100, you would right now have 25.3 lakhs, right? We also have, for your, just to make it visually even more clear, this is the returns that different asset classes have given over the last 15 years. So as you can see, Indian equity, which is Nifty 50 TRI or total return index, has given 12.4% returns. The US equity market or the S&P 500, currently we're only talking about the benchmarks, has given 19.7% returns. Gold has given 11.1% returns. I know right now gold has gone absolutely bonkers, but we're kind of trying to see the last 15 years rather than just looking at the recent viewings. So that has given 11.1% returns. Real estate has given 6.4% returns. And debt funds, if you invest in, has given 7.7% returns. So this should give you a very good clarity and should give you a very strong reason why US market should be on your radar as far as investing goes. Okay, now that we've taken a look at the last 15 years, let's take a look at the more recent performance, which is 5-year view, right? I think that'll give us a better lens at what has happened over the past 5 years, because we've seen a lot of times of turbulence in the last 5 years. If we're being honest, we've seen COVID, we've seen rate hikes, right? We've seen tech correction. So a lot of things have happened over the past 5 years. So let's take a look. Let's take a more closer look at what happened in the US market vis-a-vis these volatile periods. So we had the COVID crash in 2020, we had the rate hike cycles in 2022 and 23, and we had tech correction happen in 2022. But the US market kind of still stood strong. So NASDAQ 100 gave us almost 20.7% CAGR over the past 5 years. S&P 500 gave us 18.3% CAGR, whereas Nifty 50 gave us 16.8% CAGR. So I think what we're trying to kind of conclude here is that US market should very much be in your radar if you are actively looking to diversify, or if you're already active in the equity market. If you're only kind of subjecting yourself to the Indian markets, what happens is that not only do you carry this inherent geography risk that every country carries and not diversify it, but also you are at a disadvantage because our currency is depreciating every year against the US dollar. So now that we've talked about how you invest in the US market and what are the instruments that you can invest in, whether that's stock or ETFs or index funds, and whether you take the lump sum approach or the SIP approach, a bigger question is, what are some of the myths and mistakes that people make while investing in the US markets? So in this next segment, we'll quickly cover what are the mistakes that you should look out for and avoid, and how to choose the correct broking platform for you to start investing in the US markets, right? So number one, a major misconception that people have is that US market is only for wealthy investors. But that's absolutely a myth, because now with platforms like Appreciate in the market, you can even invest with fractional shares. I think we touched upon this briefly in our US stock market segment, but for example, a US stock seems very expensive and you feel like, oh, only wealthy investors or people who have that amount of capital can invest in the US market. But that's actually not true. With platforms like Appreciate, you can even buy shares starting from like rupee 1. So if you have a corpus of shares, just for example, 2,000 rupees, you can still very much invest in the US market, right? Bigger myth that people have is that they always keep chasing past performances. So you might think that, oh, just because certain fund or certain index has given me so and so returns in the last 1 year, that's probably the asset class that I would invest in going ahead. But that's actually not a good way to look at things, right? Because a better approach when you're investing in the equity market or actually any asset class is to look at a longer term track record, minimum to minimum of 5 to 10 years, especially if it's equity. Because equity, even though gives you higher returns, has inherent higher risk, which means that certain periods will give you insane amount of returns, but then there'll also be years where it's moving sideways or it's barely moving. So a good indicator of how you can do your research is look at more past performances, minimum 5 to 10 years, rather than just looking at like recent 1-2 years, right? Also look at how consistently a particular index fund or ETF has performed. So for example, there's a new ETF in the market, in the US market, and you're like, oh my God, this seems like this is investing in only artificial intelligence and this is what I want to go after. But because equity has such high risk, it's always a good idea, especially if you're a beginner level investor, to look at how consistently that particular ETF or index fund has performed over the past few years at least. It's good to have some indicator of past performance so that you can have faith in their future performance, right? The third bigger mistake that I see people make is they absolutely ignore the costs. They choose platforms that have extremely high brokerage rates. Say, for example, even a 1% higher expense ratio can mean a 20 to 25% lower wealth over like a 20-year compounding period, right? So even though it might right now seem like, okay, the only difference is this platform charges me 0.5% and this platform charges me 1.5%, there's only a 1% difference and it doesn't really matter. But when you take into account compounding over a long period of time, which is what is essentially what equity is all about, then you see that the difference becomes more and more significant. Sometimes, in fact, 20 to 25% lower wealth, as we discussed in the example. Another mistake that I see people make a lot when they're investing in the US market is they try and time the market. This is true for even the Indian markets, but more so in the US markets, because people try and predict markets tops and bottoms, which we all know is next to impossible, right? Even seasoned investors sometimes miss indicators that tell you that, okay, this is when the market is at its highest, or this is when the market as it is at its lowest. So 90% of returns come from being invested in the market and not the timing itself. So there's a very popular adage which says that it's the time in the market and not timing in the market that matters, which means that the more consistently you are invested in the market and for the longer duration that you're invested in the market, the probability that you will make money in the market increases, rather than you trying to think that, okay, this is probably when the market will drop and this is when I'll invest, because there is no certain way to ever tell that, right? Because if there was certainty around that, the stock market would not be as profitable as it is. It is profitable because it's high risk. So another major mistake that I see people make is not rebalancing their portfolio, right? For example, if you have 60% equity and 40% bond portfolio, and due to the market gains that happened or due to the stock market gains that happened, that balancing now has become 80-20. So now you're taking more risk than planned. So what I'm trying to say is that, say for example, you could only take a 60% risk with equity market and you wanted to be more safe in terms of like having 40% debt in your portfolio, and suddenly your portfolio has gained in terms of like the stock market has gone up and now the portfolio is more 80-20, then you're taking a higher risk. So it's always important to kind of rebalance your portfolio and at least take a look at, okay, is it aligned with the amount of risk that I'm willing to take, or is it aligned with like my longer term goals? So these are some of the mistakes that I see people make, and you should be kind of aware about them as to not do them, right? Now, how do you choose the correct broking platform? There are a lot of pointers where we discuss that, okay, some platforms have higher expense ratios and maybe they're not as easy to operate, so on and so forth. So how do we solve for that? Is you choose the correct broking platform that allows you to invest easily, that gives you a lower expense ratio, so that if you make returns, they kind of stay with you and you don't lose out on them just because the brokerage took half your profits, right? So number one, obviously look at the fee and the charges. The brokerage, is it like per trade? Is it flat or is it percentage based? That's something that people often ignore. So we've kind of put it out in at the very beginning. Look at the currency conversion markup. Now, this is extremely important because you're not investing in India anymore, you're investing in the US, right? So you need to look at, say, for example, you're investing through XYZ brokerage, and they say that, oh, we do actually charge additional money if you invest in the US market because the currency conversion actually that rates on you. So you will actually lose out on returns significantly with every trade that happens. So this is also an important thing to consider, like what is the currency conversion markup and how much are they really charging for it. Third is withdrawal and remittance fee, right? So for example, you want to withdraw your funds, or you want to remit the money outside of India. Are there any remittance charges for the same? Is that brokerage platform charging you additional money for it? Yes or no, right? What are the account maintenance charges just to maintain, like just to be on that platform? How much are they charging you? So a good indicator is to look for zero or minimal brokerage and transparent forex rates. And that's where platforms like sort of Appreciate can help you, because they give you zero or minimal brokerage charges, and they're very, very transparent about, okay, this is the forex rate, and yeah, this is how we go about things. So very, very important to consider these points when you're selecting the right platform. Next is security and compliance. You would be surprised to know how many platforms actually don't have the right credentials, but they're still in the market. But now, of course, SEBI is going down on them very heavily. But a very good indicator of a good broking platform is to see whether or not they're SEBI registered, right? If it's a US broker, it should be SEC or FINRA registered. Look for investor protection insurance like SIPC coverage in the US, and fund segregation. Your money should be separate from the brokers. Now let's look at more things that you need to consider. Third is transaction experience. Now let me help you understand how important that really is. For example, you want to do a trade right now, right this second, and you put the trade in. How much time does it take for the platform to actually execute that trade? This is extremely important when you're investing, because say for example they take a price that's not that exact second. It could be higher or lower than the price that you wanted it to be. That could be a problem for you, right? Because you showed your interest in the investment sort of transaction for a particular price. You agreed on a particular price. So look at the real time execution and what are the delays that are happening. This is especially true for a lot of brokerages that are investing outside of India, because of course there are a lot more technicalities and legalities that are involved in that. But again, look for platforms that give you a much smoother UX UI, much smoother real time execution when it comes to that. Again, the next point is exactly that. Look at the mobile app UI, right? Because nowadays we don't really take out our laptops to kind of do our SIP investments or invest in index funds or ETFs. So see how good it is or how user friendly it really is when it comes to your own mobile app. Look at the remittance process, look at the settlement time, and of course look at how good they are at resolving if you have an issue. And I think another important point to take into account is the research and investment tools. Do they have stock screeners and filters? Do they have real-time market data access? Do they have portfolio analysis tools? Do they have AI-powered recommendations and insights? And do they have educational resources for insights? So a pro tip that we can give you here is that you compare the total cost of investing 10 lakhs over 10 years across platforms, because in reality, the fees, whether that's remittance, whether that's the platform fee, whether that's currency conversion, those compound too, not just your returns, right? So it's very important to consider that you choose the right platform, which has minimal brokerage, which gives you really smooth UX UI, which gives you really smooth real time execution, gives you good analytical tools so that you know exactly how much money is in which sector, how your portfolio is performing in comparison to say the indexes, so that you have a more comprehensive view of, okay, what's really happening in my portfolio, right? So if we have to sum up today's seminar, it would basically be that if you want to invest in the US market, number one, think about the benefits that are coming largely out of the fact that, number one, you diversify your risk, and number two, there is currency depreciation that happens for the rupee, which means that you can make use of that and make more returns in the US market. Number two is that if you're a beginner investor, you should probably start small, because you're just right now getting exposed to a whole new equity market, which in itself is, like this insane market to understand. So if you're starting out, don't get overwhelmed. Start with just like a small amount. As I mentioned earlier, a platform like Appreciate will allow you to invest with just like 1 rupee and buy fractional shares. So say for example, you just want to expose yourself right now to the US market, use a platform like Appreciate and maybe start small. Start with like just some amount, maybe whether that's lump sum or SIP, that's on you, but start out small, whether that's stocks or ETFs or index funds, but slowly and gradually expose yourself to a newer market rather than going all in and like taking out all your corpus from one asset class and going all in on the other, right? So take your time to understand what the market is about, how you can get a better sense of what's happening, how you can kind of analyze what's happening, so on and so forth. And lastly, think long term. This is not just true for the US markets, but this is true for equity in general, because equity is such a high risk, high reward asset class. It's important to have a longer term view on the same, right? When you talk about asset classes like debt, it's okay if you have a smaller term view on that, because the risk is not really that high, which is why the returns are also pretty much stagnant. But when you talk about an asset class like equity, which can give you infinite returns, it's also good to have a longer term perspective on things and not be like, okay, don't treat it like a get rich quick scheme. Rather than think of it as, okay, this equity is an asset class that has the potential to make me money, but I also need to be very, very patient with it and give it time to kind of compound. Okay, now as we wrap up this session, something that we all need to remember, and which is like the biggest takeaway from this session, is the fact that investing in the US market as Indian investors is not just for the seasoned or the wealthy investors. Because as we've mentioned, there are ways to go about things where even if you're a beginner investor and don't know much about the US market, you can still make use of, say, for example, index funds or ETFs, and put global diversification within your own reach, right? And even if you don't, say, for example, have extraordinary funds to invest in the US market, you can start out small with SIPs and fractional shares using platforms like Appreciate, right? So we've talked about this in detail throughout our presentation, but I think the most important thing is to take the first step into the global markets today and think about how much that will help you, not just in terms of diversifying your current portfolio, but also make use of the currency um, like mismatch that's happening, right? So even if you're a beginner investor just starting out, make use of SIPs, make use of ETFs, index funds that we've talked about in detail, and kind of make that journey extremely seamless. And be confident, don't get overwhelmed. Just think of, if you feel like something seems very alien to you, kind of draw the parallel to Indian markets. For example, how we discussed the ETFs, right? If you feel like certain names seem very alien to you, just look them up, just research a little bit about them, and you'll feel more and more comfortable with it. Thank you so much for joining us in this masterclass. I'm very happy investing to you all.